welcome to the Capital Discussions Trading Group 2. Today is August 4th, 2015. Small crowd today, but we do have a guest. Ron Bertino has something he'd like to show us, so I'll give you the ball, Ron, and then you can go over what you had to show us.
Sure.
Yeah, that presentation, Kurt, caused quite a stir, I heard.
Yep. It's funny. It's like I just noticed today that on YouTube, some Portillo's loving people are trying to vote it down. They're trying to click on, don't like.
Right. So if everybody has a chance, go to YouTube and vote it up.
Exactly. Oh boy, funny. Okay, let me share this out. Okay, can you guys see that okay?
Yep. Yeah, fine.
Yeah, great. Actually, I'll zoom in a bit. All right, so for those that have seen the presentation before, you'll and looked at this particular spreadsheet. This spreadsheet basically gives you an easy way to just plug in the DTEs for the two legs of your calendar. You then plug in the raw Vega based on what the software is telling you, and then from that it's going to tell you what the true the true Vega or the weighted Vega is for those legs and for the spread itself for the calendar, right? But one of the things that people tend to be more interested in than this, to a degree, is this stuff here, right? So this is knowing what to change the thinkorswim inputs to in order to simulate that calendar in thinkorswim, right? So if I switch to that, all right, so if you've got something like that, and then if you were to click on this little cogwheel, click on the little chevron down here, so now this gives you the ability to, so obviously what you don't want to do is you don't want to do what conventional software does, right, where you say, okay, what happens if vol goes up by 3 points, and you go, hey, great, right? Well, it's not going to be like that because obviously you should have now learned that the legs will go up disproportionately, right? So you don't want to do it that way. So the key is to basically say, all right, well, if my front leg goes up by 1 point, how much will my back leg go up by? And that's what the spreadsheet here is going to tell you, but I wanted to kind of put it in a way that's actually easier, that you don't even need a spreadsheet as well. So if you don't have the spreadsheet around and you want to kind of plug those numbers in easily, there's an easier way to do that. Sorry, I don't know if you can hear this. I'm like a truck in the background, so I'll try and keep going. So yeah, so I just wanted to show how to kind of plug these numbers in very easily without having to have the spreadsheet around, right? Now, based on that, again, if you've seen that presentation, you'll recall in terms of the anchor DTE, I mentioned that there's no real difference, right? Some people basically say, should it be 90, should it be 30, whoops, should it be 30? It really doesn't matter, right? But an interesting way to look at this particular formula is to simply understand that what the formula is giving you is how one option compares to the other option from a Vega perspective, in terms of the Vega impact, right? So let me kind of explain what I mean. I'll just skip right to the chase and actually show you the simple way of looking at it, right? So let's say you didn't have this spreadsheet, but you, of course, know the DTE between the front leg and the back leg because you have that information in the software, right? All you would have to do is you basically pull up a calculator, right? And you simply divide the front leg by the back leg. So you say 42 divided by, here, our back DT is 189 in this example, right? That's going to give you that ratio. You then take the square root of that, and then you get a particular number, right? Now, what this number here means is that the impact of Vega on the back leg is going to be 0.47 times the impact of Vega on the front leg. Does that make sense? Right? So in other words, the impact of Vega is going to be half as much on the back leg in this case than it would be on the front leg, right? But the key thing is that I didn't need any fancy spreadsheet to figure out what I've got to put in, right? So if I get rid of the spreadsheet now, if I've done that, then that means that I know that if vol increases by 1 point on the front leg, then I know the ratio to the back leg here, right? So in other words, if this goes up by 1, then this one here is going to go up by 0.47. All right, so that is the reality of what would happen if you go up by a point, not actually before we said 3, right? So if it was 3, then if this one here is 3, then you simply multiply that by that particular ratio, and that's going to give you the number to actually plug into there. But you can see that it's going to give you a very, very different looking t plus 0. And the important thing is that, again, you don't need a fancy spreadsheet to do any calculations for you. You simply divide one DTE by the other, take the square root, and then that's going to give you the ratio that you need to plug into TOS straight away.
That's nice and simple.
Yeah. Any questions on that? It's a pretty simple thing, but I just thought it's an easier way to do it if you don't have the spreadsheet around.
Ron, hi, this is Andrew. I have a question. If you're dealing with an equity and you're dealing with, one leg before an earnings report and the other leg after, how do you deal with that?
With a lot of difficulty. Okay, the thing with earnings in particular is that, yes, you do know that IV is going to go up on the expiration for that time period that the earnings event is going to come out on, right? The difficult thing then is structuring a trade around that. Because what's going to happen is that, all right, on the lead up through to earnings, you know that IV is going to increase, or at least it should, right? Based on, if you look at almost any earnings event, it almost always happens, right? And normally what, in terms of the reason that's going to occur is that the market makers have to essentially stop people from putting on straddles, right? So, and just making a killing every single time. So they increase that particular IV of that in order to cater for that potential move. And then, of course, you get the IV crush afterwards, right? Now, the level of, and that's the simple concept, right? That we know that, yes, on that expiration that has the earnings cycle coming up, IV should go up, let's call it 2 to 3 weeks roughly prior to the event, right, in a step scale kind of thing leading to that event. The thing, though, is that when you start looking at multiple expirations that surround that expiration, then things start getting more difficult as well, right? Because the rate of increase or decrease, or even the rate of a particular expiration being affected at all, is going to be something that's tough to predict, right? Now, if you were to, the best that I've seen so far in terms of getting you information for that is LiveVol. So if you look at LiveVol, LiveVol is capable of giving you this really cool dashboard. I don't have access now at the moment, but I don't know, Tom, if one of you guys have shown this kind of stuff before, right? But it's kind of like a grid that shows you roughly about, I think, 8 prior earnings. And the cool thing about that is that it doesn't just show you, what happens during each earnings event, but it enables you to actually select and visually see the IV, not just of the expiration for the earnings, but the one behind it as well, right? So what you can do is that you can actually get a pretty good feel saying, okay, looking on the last 8 or so earnings, I can see that, yes, the front month vol is crushed by whatever, 80% of what it actually peaked at, and I can see that the back month is crushed by 50% as an average, right? So once you have that information, that can potentially be valuable, and I have played with that in the past. But even with that amount of information, I mean, to me, it just feels like a bit of a gamble, to be honest, right? Because you can have something like what happened with Apple, where they hit everything, right? Everything they said that they would, that was actually written up in the report in terms of expectations and so forth. They hit every single thing, yet the street didn't like it, and they killed them, right? And they're still going down now. They're down today like 3%, right? So it's a very tough thing to predict because, again, people can react however they want to react, regardless of what the results are. But if you do want to trade, I've found that, again, using the LiveVol historical analysis of the earnings events, it's probably going to be the best that you can do in order to figure out how best to structure a trade like a calendar so that you get a better feel for how much is my back month going to crush versus the expiration or the one that's in front and so on. It's a long-winded answer, but you know, it's a tough thing.
Yeah, I guess if you're willing to take the time, you can just go through the individual options and figure that out just from historical data with any software program.
Yeah, but it's extremely time-consuming to do that yourself, right? Whereas with this thing, you just click a button, and then you've got the last 8 or whatever it is, all in a grid, all visually. You can see exactly the crush ratios and all that kind of stuff. It looks awesome. It's really good. I mean, having said that, I no longer do the earnings events themselves. I prefer doing pre-earnings and post-earnings with various strategies, right? But I don't like doing earnings events themselves anymore.
Well, that was helpful. Thank you.
Sure.
By the way, the presentation you did was one of the best presentations I've seen in quite a while. Very impressive.
Thank you. All right. Actually, just on that, I was just reviewing a video from John Locke from one of his mentoring sessions just yesterday. And for those, you know, I know that in the community there's lots of people that follow John. What you may not know is that he's also extremely aware of weighted Vega, right? He just doesn't really talk about it much because it's not part of his strategy. But you'll find, as a matter of fact, I think I still have it loaded. It is this one here. So it is October 16, 2014. If you want to look up the date, for those of you who have access through to his group mentoring. And in that session, he actually talks about weighted Vega, even though he doesn't use the word. He describes the exact same stuff that I was actually describing in my presentation as well, right? So for those of you that put a lot of weight on John, and I do too, because you know I think the guy's awesome. He is extremely aware of it. I've gone back and forth with him by email talking about this stuff. He agrees that it's something that hardly any traders out there actually understand. And he's watched my presentation and given me great feedback on that as well. So he's on board, right? I just say that because, again, there's
what was that date again?
It was October 16...
2014. Okay.
October 16, 2014, yeah. So.
I did put the URL for that YouTube replay in the chat, so if everybody could go there and vote it up with a like, that would be great. Ron, I remember seeing not too long ago in the forums you were talking about short calendars versus straddles. Do you have time to maybe go over that a little bit?
Sure. Yeah, okay. All right, can you see it?
Just to let you know, I already upvoted it.
All right. All right, let me pull up the page. Give me a sec. I think I had it in the weighted Vega post. There we go. Okay. So this is the post on weighted Vega at the top right, but we had a person here, funnily enough, from where I grew up in Australia, and he was basically asking about the concept of doing a reverse calendar, which is a trade that not many people have either heard of or even looked at. And I kind of found it interesting because not only was he looking at a reverse calendar, but he was looking at reverse calendars with DTEs that were insanely high, right? So, you know, 700 days for the shorts and 1,000 days for the longs. Okay, I thought, wow, right? That's far out in time. So I went through and kind of did a bit of a write-up here on how all this stuff works. So, okay, so very, very briefly, over here we've basically got in green, we've got a long straddle, and I've sized it such that these trades are, roughly similar. So you can see here that I've got a 5-contract reverse calendar and a single contract straddle. Okay, so they're not equal in terms of contracts here, but it's a good kind of ratio just to show how these things compare. So again, a long straddle in green, and I've got a reverse calendar here in blue. So looking at the T+0, you can basically see that the lines are almost identical. Okay, but they kind of seem to differ a little bit over here on the upside, and on the downside, they're probably a closer match, right? Now, of course, remember that none of the software that's out there can understand weighted Vega or takes weighted Vega into consideration. So I'm kind of leaving that off to one side for now. So for now, I'm just working with raw Vega, right? Just what the software claims will happen, which will not happen. But again, that's like a side point. So the first thing was to just show, again, that these two things are similar. So we've basically got a long gamma trade here, right? So just like with a long straddle. So what you're hoping for is you're hoping for this thing to go nuts either to the downside or nuts to the upside, right? So the bigger move that you get, the more money you're going to make, in theory, right? So that was the first thing, and just showing that these things are similar. But then this is kind of a hint when you start looking up here that, maybe there is some difference. But if you then start looking at the Greeks, which is what we've got here, then there's some interesting things to kind of point out, right? So first up, they're both pretty much delta flat when you start, so that's fine. The gamma, you can see here, is extremely comparable. It's almost identical, so that's good. Theta is the first thing that gives you a bit of a difference. So you can see here that you've basically got roughly 3 times the amount of theta expense, because it's negative theta here, with the long straddle than you do with the reverse calendar, right? So that's good for the reverse calendar. So that means it's 3 times cheaper. And all right, so let me kind of take a step back. When you're doing either a long straddle or something that is long gamma like this, people tend to, that trade these types of structures, a lot of the time they call it what's called gamma scalping. And what gamma scalping is that you place a trade, the conventional thing is that you basically place a trade in low IV environments with the expectation of IV going up, and you want a breakout in one direction or the other, but you don't care to predict which direction it's going to go in. You just know it's going to break out, right? So you put on one of these things, let's say a long straddle, then as you then get a flush down in price, what you can do is you can actually scalp that, meaning that when price moves down, let's say to this point over here, what you don't want is you don't want then to have a bounce and for the price to go back to where it was and you've made nothing. Right, you're back to where you started. So when this thing moves down, once you feel that it's, let's say, hit support, then at that point you rebalance this position such that your dot is essentially at the bottom of the U-shape. Okay, and I won't go into kind of how to do that because there's various ways to scalp. You can do it with stock or futures or just rebalancing your options and all that kind of stuff. But the point is that you can set the dot being back to the bottom of that U-shape, so that now if you do get a bounce back, you're now, it's similar to being at the bottom here, now getting a move to the upside, so you're actually making money on the way up. Okay, so you made money on the way down, you rebalanced, and now on the way back up, you made money again. And you just keep doing that, and that's called gamma scalping. Okay, it's kind of tough to actually make it work. I've tried it before, and it's tough to make money on it. You've got to be, let's just say, pretty good at it, right? And have very cheap commissions. If you don't have cheap commissions, you get this trade on that. But anyway, it's a separate topic. So the concept of this kind of stuff is, again, you make money when you get big movement up or big movement down, which is what I assume that this person, I think his name was Costa, Costa, wanted to do, right? Now, the thing, though, is that he was going like way out in time. Oh, sorry, I forgot one last thing here. The last Greek to compare, and it's an important one, is the Vega between these two trades. Notice that the long straddle is positive Vega, whereas the reverse calendar is actually negative Vega. And that's interesting, right? Because if you think about that, then that means that between these two trades, if you were to get a move up, right, then with a move up, typically you're going to get a reduction in IV, right? So with a reduction in IV, and again, you can kind of then look at this and you say, well, if this guy here is negative Vega, and you get a move up, which therefore brings your IV down, then that's going to help my reverse calendar, right? Whereas my long straddle, even though you're going to be making money from the gamma and the delta here, then you're actually, since you're positive you're positive Vega, you're actually going to be getting hurt on the way up because you're positive Vega, right, on the assumption that IV is going down. So, and this is the reason why you get this discrepancy here, right? And this is why you're, in reality, even though the software kind of is claiming different here, in reality what's going to happen is that the reverse calendar is actually going to do better on the upside because it's negative Vega, whereas your long straddle is going to be better on the downside because it's long Vega, right? So that's another interesting kind of difference between these two things. So,
Ron, isn't that reverse calendar less negative Vega than the software shows?
Absolutely, yes. So, and that's important too, right? Because what's important, and this is why I was saying that weighted Vega is definitely something that's worth considering, but the software is not going to show you that. No software is going to show you that at the moment. There's nothing out there that does weighted Vega yet, right? So the second that you're doing the reverse calendar, since that's dealing with multiple expirations, that's absolutely going to affect you. And you might say, well, long straddles aren't going to be affected by weighted Vega, but that would be wrong, because what matters is where is it in time. If it's far out in time, like this guy was basically saying he wanted to set something up way out, like 700 and 1,000 days out, then you bet your bottom dollar that you'll be affected by weighted Vega, right? If something important happens tomorrow and the market goes down by 50 points, that does not mean that something that's 1,000 DTE out is going to be affected in the slightest. Okay, so yeah, weighted Vega is absolutely an issue when you're out in time, let's say further than 60 days, or when you're dealing with multiple expirations. Okay, so but you're right, it absolutely would be affected. I'm just trying to kind of keep it simple to show a couple of things to the person that was asking the question, just about the trade in general. So does that answer that?
I think so, yeah.
Yeah, okay. All right, so then the key thing is kind of showing, I wanted to make sure that there wasn't a misconception about one of the things that I was saying in my session, which is I kind of explained that when you go further out in time, your gamma reduces, right? And in the context of what I was talking about, I was basically saying that was a good thing, right? So if you're in a negative Vega trade and therefore positive theta, if you have the option of trading something that can make you money, and let's pretend that it's the same amount of money, and I gave you the option of having a trade that had, a gamma of 5 versus a gamma of 0.1, right? Then obviously you want the gamma of 0.1, right? You're not going to be affected by volatility. By price movement, I should say, much, right? Because your gamma is really flat, right? It's the flat T plus 0, in other words, right? So do you want a flat T plus 0, or do you want a really steep, curvy T plus 0, right? Most people want a flat T plus 0, right? So people can sometimes think, okay, therefore, going way out in time is what I should do, because that's a so-called safer trade, right? Now, that would be wrong in this case, because what we're doing here is we're not, the danger with a trade that like this, like a long straddle or a reverse calendar, is not price movement. I want price movement, right? I want this thing to go to the moon or crash and go to 0, right? I'll make a killing, right? What my danger point is this, valley of death, right? And the valley of death is going to be affected by two things. It's going to be affected by theta decay, and it's going to be affected by Vega, right? So if you get an adverse move against the position, because again, these positions are different from a Vega perspective. I mean, they're complete opposites actually, right? But if you get Vega going against your trade, then that could potentially sink you down that graph and give you losses. And then on a daily basis, you're also going to be losing money, right? So every single day, you're further and further down that valley of death, right? So the longer you take to make money, the more you lose, right? So those are your two risk points with these types of trades, right? You want the thing to move quickly, and you want it to move as much as humanly possible, right? So that's how you basically make money, and that's how you lose money in this particular trade. Now, when it comes through to looking at your gamma, which is the curvature of your T plus 0, if you think about it now, you now actually want the opposite. You don't want a really flat T plus 0. You want a really, really curvy t plus 0, right? Such that a minimal move up or down is going to give you the maximum profit, right? So when you're doing these types of trades, which are essentially long gamma trades, then you want to have a very curvy t plus 0. How are you going to get that? You're going to get that by being closer in time, not further out in time, right? Because that rule still applies. The further out in time you go, the smaller your gamma. So the flatter the t plus 0 will be, right? And this is what I then kind of went on to show the guy here. Let me pull this guy up. All right, and I actually just showed the Greeks. So, so if you basically compare your gamma now, you can see that the gamma of the closer in time trade was 0.89, and the gamma of this, way out in time trade was 0.05. Okay, so what this implies is that as we expect, the further out in time you go, the smaller the gamma is going to be. But what that's going to give you is again a very, very flat t plus 0 line, such that you need a huge movement up or down in order to make any money, right? So you're minimizing your potential of making money from gamma and delta, and you still have to live with the risks of Vega and theta, right? So long story short, when you're doing gamma scalping type trading, the almost every mentor that I've been under and people that I've talked to that do gamma scalping, almost everybody is going to do it at a 60 DTE or less. Okay, if you're more aggressive, you set it up at about 30, and if you're more conservative, you go at about 60. Right? 60 is a good balance. It gives you time to allow the underlying to move, because sometimes things can sit in consolidation for a week before they decide to move. So it gives you time. And it still gives you a decent amount of gamma, being at 60 days out, right? If you're more aggressive and you're basically saying, this thing is wound up so tight that I just know that it's going to go like tomorrow. Tomorrow this thing is going to explode, right? Or in the next couple of days, then you want more gamma, right? You're willing to take that risk, and therefore you go in closer in time. So you set up your long straddle or a strangle or a reverse calendar, right? One of those three, but closer in time, let's say at 30 days. And I know some people that, go crazy and they go, 14 days out or whatever, but I'm just not willing to go anywhere near that close. So I tend to, when I do gamma scalping, depending on how aggressive I am, I'll go either 60 DT, which is what I typically do, or I'll do 30, right? But just remember to be aware of what, even though this looks like a riskless trade, right? There's no way I can lose, right? Well, there's no way I can lose right now. Tomorrow, I'm going to be down money from theta decay, and if volatility goes against me, then I'm going to be down as well. Okay, so you can very quickly start getting into the valley of death, and then you start, crossing your fingers and praying, and you go, please move, and you keep waiting, and every day you're deeper and deeper and deeper and deeper, and you hit your max loss. And hopefully you've set your max loss prior to getting in the trade. Most people, by the way, set a max loss, which is roughly about halfway down the valley of death. Okay, so if you get to roughly about here, in this case it would be about 2,500, then you say, okay, I'm out, right? I'm not staying in this thing. It's just not moving. It's not doing what I intend. I'm gone. All right, and that was basically it, Tom, unless you guys have questions.
Paul Demers,
Ron?
I know you mentioned that OptionView does show some weighted Vega effect.
Okay, no. What OptionView does at the moment is that it does include the IVs across the term structure. Okay, so in other words, if you have something like a calendar which has multiple expirations, then what they do is they leverage the SEV model, right, which is the constant elasticity of volatility, right? So in other words, if you, let me kind of show here. All right, so if you look at an option chain, the option chain here has IVs per strike, okay? So what's going to happen is that these IVs are already set. So when people use certain software and they basically say, okay, I'm going to do my fire drill at the end of the day, right? So let's see what happens if price moves down by 1 or 2 standard deviations and I increase IV by, say, 2 points, right? And then they say, all right, let's see what happens if price moves up by 1 or 2 standard deviations and IV goes down by a point, because that's roughly what they're expecting IV to do based on that movement, right? The thing is that there's a lot of that information is already contained in the option chain. So you can see here that you actually get all these IVs that tell you what the IV is for a particular strike, right? So if you were to get movement in one direction or another, what this model does, which is what OptionView does, is that it's able to leverage this IV information, which is called the vertical skew, in order to have a much better simulation of what would actually happen to IV if you got that jump in price. So if it moved by 20 points, you're not taking a guess saying, well, it should roughly go down by a point. No, the chain actually tells you, right, how much IV will change by, on average. Of course, things can get out of whack. If there's a lot of fear, then the overall IV could increase even more, right? But in general, this SEV model, the CEV, is quite good, right? It actually gets pretty close without doing anything fancy. It's basically just taking advantage of what the option chain is already telling you, okay? Now, if you have multiple expirations and you're looking at, September and October, right? Now, of course, each option chain already has all the implied volatility information in it. So if you were to get a move of, let's say, 20 points down or 20 points up, what OptionView can do is that they can leverage the vertical skew, the IV information from the chain, from each of those expirations and track them across that term structure, right? So each leg is tracked independently, which is what you want, right? Because obviously the IVs are not going to be identical. The IVs that are further out in time will be higher, as we explained in the last video, right? So that's what OptionView can do. It can take into account, via the constant elasticity of volatility model, the term structure variances between the two separate expiration cycles in order to give you a pretty good approximation of what would actually happen from an IV perspective across both legs, right? And that's great, right? That's really good. But that is completely different to the concept of weighted Vega. Weighted Vega is not that. It's basically saying, well, if I have an event that happens today, then how is the impact, that ripple effect that we talked about in the video, right? That ripple effect is not taken into consideration today, right? They've been in touch with me already, and that they said that they're considering working together or whatever to see if that can be added, but it does not currently exist in the software today. They do have the volatility cone, right? But they, let me kind of show you. Sorry, just rinse. You know what? I should probably bring it up here. I know one of my trading buddies would appreciate the shout out for this. You guys have probably noticed that OptionView has gone from 7.63 to 7.65, right? I strongly encourage you to look at your T+0s if you've upgraded to 7.65. We're seeing really wacky stuff, right? So I've actually reverted back to 7.63, right? The T+0s have gone crazy on me, so just putting that out there, okay? All right, getting back on topic though, if you go through to, you click on model and then you click on volatility, so this thing here, this basically shows you what's called the volatility cone, right? Similar to what iVolatility does. So it shows you the term structure, so you can see here that we still have contango, right? As you go further out in time, the IVs are getting higher. Everything's normal, circled normal, okay? The second that this red dot pops, is equal or higher through to the back month, then we're essentially in backwardation. So you do see this. So this is useful. But as I've said, the concept of weighted Vega is not currently built into any of the retail platforms. None of the brokers, not OptionView, not OptionNet Explorer, none of them have it. I'm hoping that's something that we have the option to, a little tick box that we can say, all right, show me what weighted Vega would do, right? But we're not there yet. Does that answer that?
Yeah, how do you revert back to a previous version of OptionView? That's interesting.
Yeah, what I did is I just found that I had the older version in my downloads folder, you know, because I tend to kind of be lazy and not clear out my downloads folder that often. So I found that it was there, and I just went back to that and reinstalled it.
Oh, okay, fair enough.
Yeah. And I've got this here too. This is the kind of thing we're seeing, okay? So this is 7.64 doing an M3, right? Looks pretty normal, right? Look what 765 is doing. Okay? So if you want to trade this T+0 down here, then enjoy version 765. Right? Otherwise, log a ticket with OptionView and get them to change this thing to fix it, right? Because I can't trade with this, right? I need 763 back.
Have you sent that to him?
Yeah, we've been in contact. Well, a friend of mine has already been in contact with him. We sent him this note. I validated. I'm getting the same kind of stuff from the bottom as well when I was running some backtest last night. And I thought it was something wacky with my data, but it wasn't. It was that I had upgraded to 765. So I at least know that it's myself and my trading friend that are experiencing the same issue. I'm assuming, therefore, that it's something that affects probably everybody. I'm just surprised no one's been complaining about it, to be honest. I would have expected the Skype chats to be going nuts right now. So please check that. And if you do find something like that, then let OptionView know, because I certainly am. I want this thing fixed.
Ray said the at expiry structure plot line does not stay constant when you have multiple options expiry series. Ray, you talking about OptionView?
Well, there's just two things. Granted, Ron's trying to be simple, and in general in his conversation, but the structure line, the plot line at expiration, does not stay constant when there's multiple series. So when we show the straddle and the short calendar, that calendar plot line is not going to stay consistent when volatility moves. So what we're seeing there needs to be interpreted that it's not the full truth.
Absolutely. Yeah, and for those of you that have traded calendars before, you will know that calendars are one of the, or diagonals, I guess, fall into this, or ratio calendars and so on, right? But they're one of the few structures that the entire structure, including the expiration line, will move up and down. Right? Everybody's used to the expiration line just staying exactly where it is, right? Like butterflies and everything else. Well, you're not going to get that with those other structures, right? So that's another reason that tends to frustrate people with calendar-style trades as well.
And the other question I had was that the way to Vega is not a linear thing nor an accurate thing. At best, it's just your best swag, right?
Yeah. Mm-hmm.
Okay, because it was coming across to me, at least, that we've got this calculator, your spreadsheet, you can put it in and it's going to give you an accurate number, not necessarily a swag. And a swag is better than nothing, but a swag is not an accurate number.
Okay, so I agree with that point. Now, if you read through the PDF report that I had put out, you'll basically see that, and I actually tried to put this into the slide presentations as well, right? Where we basically say, all right, we know that this is, a so-called rough figure of working out what weighted Vega is, but the point is that if you compare what the software told you would happen compared through to what happens if you take this simple formula into account, the simple formula got you much, much closer to reality than the software that didn't take weighted Vega into account at all, right? So it's not perfect, absolutely, but it gets you a lot closer.
Cool. I just wanted to give you the chance to say that.
Yep. And there's actually multiple models of weighted Vega out there, right? Even in the Seams book, he kind of covers about 3 of them. The one that I presented in the formula here is he actually admits, he says this is an extremely simplistic model, but it's good enough to start with. He then covers more advanced models, which are way above my pay grade to understand them. And I've heard through some people that trade hedge funds and all this kind of stuff that they have very, very expensive software that's exclusive just to them that does all the weighted Vega calculations for them, right, which is not available to the retail public. So I'm sure there are many very advanced models of doing weighted Vega. We just don't have access to it for now. We just have access to this simple formula, but even the simple formula is going to give you more accurate results than what the software shows. And again, this is just based on actual testing. This is not some theory, and this is something else that's floating around. People are saying, do you believe in weighted Vega? There's no belief here. This is not a religion, okay? This is just basically looking at the differential between what the software simulation, the software is actually the one that believes that something's going to occur, right? What we're actually doing, though, is that we're looking at reality, right? We say, okay, this is what the simulation is. Now let's put the trade on. Let's see what happens to the trade. And if there's a differential between what was simulated versus what actually happened, let's try and understand why, right? And the why is the weighted Vega. And then if you apply the concept to the reality model, you're going to get a much, much closer model or prediction of what that movement is going to give you from a P&L perspective versus what the software actually so-called believed. Okay? So weighted Vega is not a belief. It's simply an application of options theory to software that just doesn't take it into account yet. Right? But what I strongly recommend everyone to do is simply test it out yourself. Don't believe me at all. Okay? Just test it out yourself. You'll see it with your own eyes. This stuff works.
Ron, I have a question for you. If you wanted to do gamma scalping, would you use something like average true range or standard deviation to determine the price point where you would actually put on the gamma scalp?
Yeah. Okay, there's a lot of detail to gamma scalping, but yes, that's one of the things that's commonly done. People want volatile underlyings, right? You don't want something like IBM, right, that hardly moves, right, typically. You want something that's very volatile, so people kind of gravitate to the Teslas and the Netflixes and all that kind of stuff, right? So yes, you want something that moves around, but when you're setting these things up, again, you have to be very aware of the things that can hurt you, which is theta and is Vega. If you get movements against you, that's going to hurt. And also, if you're trying to gamma scalp, you then have multiple other decisions to make, right, which is when are you going to gamma scalp? So when you get a movement that goes down, if you're here and the thing goes to, let's say, here, right, you might be up money, but not much. And you go, well, I'm going to hold on. Next thing you know, instead of keeping moving down here, it moves back to the middle. But now you're not back to the middle anymore. Now you're back to about here. So now you're down $500. Right? Now you're kicking yourself on not having taken the $100 profit when you were there and rebalancing, such that you would have rebalanced the dot to be back at the bottom of this U-shape. Right? So there are two ways to go about it. One way is to use some even basic form of technical analysis where you're not just looking at this T plus 0, you're actually looking at the chart and indicators and support and resistance levels and so on, right? So you say, all right, if this thing moves, you wait for it to break out. When it starts breaking out, you then look at the chart to see where the next resistance line is or where the next support line is. When it gets close to that, you rebalance, right? Regardless of whether the thing is going to keep, if it's just going to slice through that support or resistance level or if it's going to bounce. You don't care. You want to be safe and you rebalance. Right? That's one way. So you use technical analysis. The second way that people do this, and well, there are pros and cons, but the second way that you can do this is that what people do is they set up brackets on both sides in a scaling fashion. So for example, they set up a contingent order roughly around here, and they'll normally do something like, let's say, a half standard deviation daily, right, on either side. Then they'll do a 1 standard deviation daily on either side. Then they'll do a 1.5, then they'll do a 2. Right? Then as your price goes through that price point, then your contingent order is already taking care of the rebalancing. If it keeps going left or right, well, actually left in this particular case, those other contingent orders are already in place to rebalance. So even if you get a huge move down, you've now had to cross through 3 or 4 different contingent orders that rebalanced you at every point. So now when you get that whipsaw back, you're not hurting. You're actually making money on the way back up as well. You're not going back to 0. Okay? Now, that can work. You just have to kind of, it's a bit of a challenge to figure out where do you place, how far out do you place those contingent orders to do the rebalancing for you. So that's one point. Because if you do it too frequently, then you're going to get eaten up by commissions, right? If you do it too far out, then you're okay from a commission perspective, but what if that contingent order didn't get hit before this thing reverts and goes back? Now you're back to where you started, or worse, now you're losing money, right? So that's a toss-up. You have to figure out, and that can have to do with understanding, having a good feel for the underlying, knowing roughly how much it moves, and so on. Personally, I think, oh, and by the way, when your contingent orders on the way down are getting taken out, the thing to remember is that when you start getting alerts telling you that you're rebalancing, because every time you rebalance, you're making money. So every time you get one of those alerts, it's a good alert, okay? But now those contingent orders are gone. So what you want to do is that once you start getting, let's say, 2 of your contingent orders fire, you want to go in and now fill in contingent orders for the upside, so that when it comes back up, you're now rebalancing on the way back up too. Does that make sense? Right?
You'll also need a position that's big enough that you can have the granularity to do multiple scale-ins.
Yes, yes. So, and there's multiple ways to do that too, right? So the most conventional way of gamma scalping is that you basically set up a long straddle or a strangle, and you then scalp with stock, right? So if you're, at this point here, you're going to be negative delta, right? So if you're negative delta and you want to rebalance, you buy stock that's going to give you positive deltas, and then you're now rebalanced back at the bottom of the U shape, right? You do not touch the long straddle or the long strangle. You leave it there. That is the conventional way to gamma scalp, right? And some people are religious about it, right? They say that is the way to do it. If you do anything else, you're stupid, right? But that's not entirely true. There are other ways of doing it. Another way that you can do this is you can, and this is now where you do have to scale up a bit, right? But you can buy, let's say, 10 contracts of the long straddle or strangle, and then when your price movement goes somewhere, you basically start either buying or selling extra contracts to rebalance your position out, right? So you can do that. You can also do it with futures. And the fanciest ones that I've seen, which I've actually posted a link to on the Capital Discussions forum already in the gamma scalping thread, there's a guy called Paul Forcioni, good trader. I like his stuff a lot actually. And what he does is really creative. What he does is that he actually combines mini option contracts together with full-scale option contracts. And I know that may not make sense, but basically what he's doing is that he's figured out a way to do gamma scalping such that he cuts his theta in half, because he's not buying both legs of the long straddle. He's only buying one, and he's getting the other leg with mini options. With mini futures contracts. So just if you're interested in that, check out the thread on gamma scalping and Capital Discussions, and I've posted a link to the video. He does like a 1-hour session explaining how that works. So that's quite creative. I gave that a try a while back, and that can work too. Again, pros and cons to every single one of these strategies that I've mentioned, though.
What is one leg a synthetic by using the underlying?
Yes. And therefore, since it's synthetic, there's no theta decay on it, right? So he sets up essentially one leg of his straddle using futures, and the other leg using options, so he's therefore only paying for half the theta decay, right? So that's pretty creative, I thought, right? Cutting your theta in half, and that can work. And also it cuts your Vega too, right? Because since it's a futures contract, providing half of the straddle essentially, then you're not getting hurt by Vega and you're not getting hurt by theta. So you cut both of your risks in half. So I thought that was pretty cool.
Ron, in your presentation too, I think the RBX had gone from 18.7 to 21.54, and your slides were at 2.54, but it's actually 2.84. So the formula that you used actually was closer than what you showed in your presentation to the actual.
Okay. Yeah, I have been in conversations with various people. Like I talked in length to Jim at OptionView about the weighted Vega thing, and and also about the differences between the software and all this kind of stuff, right? So he was acknowledging certain things and, you know, giving tips for certain other things and so on. So I'm actually going to be working on a new report. I would hope within the next month or two that will do a comparison between the different softwares and how they work, and things to be taken into account that can get us slightly more accurate estimations. So for example, one of the things that he pointed out was he was suggesting to not use the RVX as a measure of what the volatility change was, because the RVX, based on his explanation, was essentially more or less an average of the entire chain, and his feeling was that you would get a better indication of looking at the before and the after of the at-the-money IV of the calls, and that was his preference. So I'll be testing out those types of things to see if we can get more accurate estimations for running fire drills at the end of the day, and then seeing how those fire drills compare between the different software. So, and I'm also waiting on hopefully new versions of software that may be coming out soon that can give us some more functionality as well. Right. Long story short, though, is test it out yourself, guys. Right? So again, don't take my word for it. Just test it out with real back tests, not with what the software simulates and thinks that will happen. Just put the trade on, see what happens afterwards, and then see if weighted Vega is going to give you a more accurate prediction of what should have occurred. I think you'll find that it does.
Now, Paul, I know you've done quite a bit of work with weighted Vega too.
Yes, I have. Hi, everyone.
Paul?
You know, I just have a couple comments on it. I did that quite a while ago, you know, and I have spreadsheets, and I never look at spreadsheets anymore. I don't even bother with them. My opinion on weighted Vega is that, you know, it's I think it is definitely a more accurate way to see how calendars work. But you know, now that I found out, you know, it's like, oh, the aha moment. This is, you know, the calendars closer to expiration get affected by the changes in volatility much more dramatically than further away from the money. So, as you know, I'm sure everybody knows, you know, I'm trading my calendars out, way out in time, and that was based on what I found out when I discovered the weighted Vega, did some testing like Ron's done. And so, you know, once you get the concept of how calendars really work, I don't know that, for me personally, there's not a need for me to go into spreadsheets and do a bunch of calculations out on them. I just put on, you know, what my calendars, the short strike of my calendars get to, you know, 30 days, 35 days. I'm taking them off. They really get affected by the volatility spikes that the weighted Vega shows you they're more prominent in the short-term calendars. So it's been very useful to me to start doing calendar trades, but I don't know that I really don't spend a lot of time with it anymore.
Dave Stewart says you're not allowed to simplify things, Paul.
Well, that's, you know, I'm a very simple person. I need things very simply. So my opinion is very valid. I use the same formula from Talib that Ron has shown. And I think with my back testing, it showed it was, you know, reasonably accurate to what's actually going to happen. So I don't think there's any discount in the formula. Nothing's perfect. The market is the market, and you know it's really kind of based on what the pricing action is and the options you have, and who's buying and who's selling, and whether or not they've decided that the strike that you are short, they may have decided that's where they're going to buy their puts, on a put calendar to protect their positions, and all of a sudden your calendar is down a lot of money because there's a lot of buying pressure on your short. So that's stuff that you can't calculate out in any formula or any piece of software. That basic supply and demand.
Very true. Well, gents, we're almost at an hour, and I think that's probably a good place to stop unless anybody has any last questions for Ron, Paul, or the group about weighted Vega or what we've gone over today. I don't see any more questions, so why don't we call this a good stopping point and regroup next week. And thanks, Ron, for taking the time to come and show us what you've been working on. And it's really interesting stuff. And as Bruno said, you certainly know your stuff.
All right. Happy to help.
We'll see you next week.
All right.
Have a good day.
Take care.
Thanks.